let's talk about bonds for a second.
Please subscribe to our channel. Have fun trading. Make that cash a blaze. And manage your risk.
First of all, these are these are the bonds on the futures in the futures world. You have this ZT is the 2-year bond. You have the 5-year bond, which is the ZF, and then you have the 10-year bond, which is this ZN, and then you have the the 30-year bond, which is the ZB, right? So you can play these by using the futures, actual futures contracts, or you can play them by using the options. Most of the time, we're playing the options, and most of the time, I'm playing the ZB, the 30-year options. Now, when these are going up, and they're going up today, as you can see, then interest rates are going down. Okay? So, whenever you see this going up, interest rates that people buy for or use for buying a house, people focus on these interest rates for the house because you're going to be, buying a house for 15, 30 years, whatever the case may be, right? So these bonds, these 30-year bonds, literally affect the price of the interest rate of buying a house. And normally it's what is called contango. The market is in contango, meaning that the 2-year, as I say, it's giving you 1% yield, right? And the 5-year, let's say, it's giving you 2% yield, just for example. And the 10-year, let's say, it's giving you 3% yield. And then the 30-year, let's say, it's giving you 5% yield or whatever, right? So this is normal type of market. But sometimes it'll have an inverted yield curve where the 2-year is giving more than the 5, or the 5 is yielding more than the 10-year, or the 10-year is yielding more than the 50-year, and that's that's not a normal type of market when that type of situation is occurring. Okay? And so when that happens, then people are going to probably be buying a lot more short-term yields, because you're not going to buy a 10-year when you can get a better yield at the 5, or you're not going to buy a 30-year when you can get a better yield at the 10, and so forth, right? And as we were talking about earlier, is that bonds all have a maturity date, or like an endpoint. They have an expiration. So if you're going to buy a bond, let's say a treasury bond for 30 years, right? And let's say it's paying you, this is what happened with Silicon Valley and other banks. Let's say it's paying you 2% at that time. And then let's say now that, the 30-year bond is trading at 5%, right? So that is a big difference. And so, yeah, it doesn't matter if you're going to literally hold this until expiration and you get your principal back and it's paying you 2%, but most bonds are traded eventually, right? And so if that's the case, you're not going to be able to sell your bond when people can buy it for 5%. You're going to have to give them a discount so they can get that 5% still. So you're going to actually lose on your money. You're going to lose because you have to sell it for a discount, right? You gave some people, you gave X amount for the government to borrow your money, and you're going to have to sell it for Y amount, which is less than X amount. So that becomes a problem. And with banks, they're going to have some liquidity. And I don't know what they did to how they were determining that, okay, we should buy X amount of 30s, X amount of 10s, or whatever the case may be. I don't know how, but whichever scenario they came up with, it did not work, right? It didn't work correctly. I think it's just important to kind of point out certain things with bonds. So points to know: bonds can be issued by companies or governments and generally pay a stated interest rate. Okay, so that's going to say if you're buying from a government, it's going to be basically around the type of rates I just said, 1%, 2%, 5%. 5% is usually going to be something for a 30-year mortgage or something like, or a 30-year treasury or something like that. You can have what is called high yield bonds or junk bonds that you buy from certain companies that are a little bit more risky, but the yield is going to be higher because it has to reflect the risk. So if the risk is very, very low, which is considered no risk with U.S. Treasuries and so forth, at this point, right? That might change in the future, but at this point, you're going to get your principal back and you're going to get the interest on it if that's what you want, right? So if you want to hold something to maturity, then that's fine if you're okay with it. But if you have to sell it, then that's where the problem could happen, right? If you had to sell it because a yield is higher, then that would be a problem. If the yield is lower, then obviously you can sell your bonds for some premium. All right, so the market value of a bond changes over time as it becomes more or less attractive to potential buyers. Bonds that are higher quality, more likely to be paid on time, are generally offered at lower interest rates. That's basically what I was just saying, right? So bonds that have shorter maturities, linked until full repayment, that's what that means, tend to offer lower interest rates, right? So if you have more clarity, if you have a bond that has, the principal is paid out in a year, well, it's more clarity there. If it's 2 years off, it's still more clarity, right? Once you start getting 5, 10, it's less clarity, so they're gonna have to pay more for you to issue them money, right? Because when you buy a bond, you're giving someone a loan, basically, right? You're giving the government a loan, you're giving the company a loan, you're giving them a loan, and they're saying, okay, for you giving this loan, I'm going to pay you X amount in interest, and then I'm going to give you your principal back on this day. Okay. So bonds are issued by governments, corporations, like we said. By buying a bond, you are giving the issuer a loan. We talked about that. And let's move on. Let's talk about this: holding bonds versus trading bonds. If you buy a bond, you can simply collect the interest payments while waiting for the bond to reach maturity. That's what we talked about, right? However, you can also buy and sell bonds on a secondary market. After bonds are initially issued, their worth will fluctuate, like the stock prices, right? They'll fluctuate, and that's where the problem happened with the Silicon Valley. It's going to fluctuate. So now if they try to offload or get out of their bond, they're going to have to get it out less than favorable terms, and then that causes a problem. Okay, or that did cause a problem. So bond terms to know, right? A coupon. This is the interest rate paid by the bond. In most cases, it won't change after the bond is issued, right? So it doesn't change. But what happens is that you have to give, if the actual market interest rate change, well, then you have to give a discount for someone to buy it. So the yield, this is the measure of interest that takes into account the bond's fluctuating changes in value. There are different ways to measure yield, but the simplest is the coupon of the bond dividend divided by the current price, right? So face value, usually face value is about $1,000 for a bond. The price, this is the amount that the bond would currently cost on the secondary market. Several factors play into the bond's current price, but one of the biggest is how favorable its coupon is compared with other similar bonds. So that's what we've been talking about, right? That's what we've been talking about. So then if we continue, and hopefully this is not too basic, but I don't think so. Bonds are interesting. A bond maturity refers to the length of time until you will get the bond's face value back, right? That principal. That's what that means. So you have this is like a graph is saying the yields. The longer the expiration, usually those yields are higher the longer you let somebody borrow your money, right, before giving your principal back. Well, but sometimes that can be inverted, right? This 10-year can be worth more than the 30-year here, and that would be an inverted yield curve. All right, so quality bonds, we talked about that. You got government. By the U.S. government, it's considered risk-free. You got some governments that can give out bonds, but it wouldn't be considered risk-free. So some governments have to pay a lot to borrow money. At this point, the U.S. doesn't have to pay a lot to borrow money. They're paying more now because interest rates are higher. But when interest rates were darn near zero, right, the U.S. was borrowing money for significantly low prices, right? It's basically they're taking your money for nothing and being able to facilitate the government's operations, right? So you got these different type of bills. You got the treasury bills have maturities of 1 year or less. You have treasury notes have maturities of 2 years and 10 years. Treasury bonds have maturities of more than 10 years. Most commonly is 30 years. Okay, and then you got what's called TIPS. It's in treasury inflation protected securities. So that means if you buy this, if inflation goes up, then your coupon is going to go up. Your interest rate is going to go up, right? If you're interested in buying the treasuries, you can do it from TD Ameritrade. You can do it from Merrill Lynch. You can do it from Charles Schwab, which is basically TD Ameritrade now. Or you can buy bonds directly from the government, right? So it's several ways you can do it if you wanted to buy bonds and kind of diversify your kind of portfolio. They do have some bond ETFs, and one that I'm using recently is this one here. It's BND. This is a Vanguard Total Bond Market ETF, right? And you can see that this pays out monthly.